Have you ever heard of the over-the-counter markets? Like in the real world, if you go to a counter in a bar, basically, you negotiate directly with the bartender. Like, you order a drink and you pay the price for the drink. So you can have specifics in your drink. So that is what we call over-the-counter negotiation, over-the-counter market. So the Forex market, the international currency market, is primarily an over-the-counter market or an OTC market, where the brokers and the dealers negotiate directly with one another. Now, an over-the-counter market is the process of trading securities via a broker-dealer network. So basically, we usually trade currencies. We usually take our trades in broker platforms. In turn, these brokers would negotiate directly with the dealers, usually using an electronic communication network between them. So basically, the main participants in this market are large international banks. And these large international banks are the one which continually provide the market with the buying prices and selling prices. And we call them the bid and ask prices respectively. And the central banks are also major participants in the FX markets, and they use the market to control money supply, they control inflation, they control interest rates. So an OTC market generally is not under any supervision or regulation of the central exchange. So we are trading that kind of market. And in this market, we have several types of transactions. And basically, we have the spot transaction and the forex transaction. Now, let's go back to the banks. And in the banks, we have the Forex business and we have the dealers who are in the treasury department. We have the Forex trading there. And those dealers will negotiate directly with the clients. We have companies who are negotiating directly with them. We have high net worth individuals. We have the brokers, etc. Now, in the Forex business, you'll find that we have the bureau de change. The bank is willing to buy maybe the euro or is willing to buy the dollar at this price and willing to sell it at another price. And usually the buying price for them is lower and the selling price is high. So the difference, which is the spread, is where they make the profit. So when you go with maybe you have 1,000 USDs and you want to exchange it with the euros or to exchange it with the South African rand, therefore you give out 1,000 USD, they give you back the South African rand. So that is what we call a spot transaction. So and the rate that they used to do that, that's what we call the spot rate. So what we do in the Forex market, we do the spot transaction, or we use the spot rates that are quoted on our computer screens, and we are willing to exchange one currency for another using that rate that is quoted on our computer screens. So, however, in many cases, spot transactions usually are settled. That means the currencies actually change hands and arrive in recipients' bank accounts. But in the Forex market, we have the brokers who take control of this. By the end of the trading day, they usually have the means of maintaining that trade to the next day. Like the exchange of currencies is not there. But in the real world, for example, a dealer is negotiating directly with a client who is from the foreign current. From the foreign country. The currencies will actually have to change hands. The currencies will actually have to arrive in the recipient's bank account. And it usually takes 2 business days for that transaction to be completed. So we have the T+2 in the financial market. And we also have the forward transaction. For example, when you take an example of a company that buys the raw materials from the foreign country, that means they use foreign money to buy the raw materials. And maybe they buy at large amounts. So the exchange rate is very important for them to budget. So when they do the budget, maybe they do their annual budget or the 6 months budget, they usually use the fixed interest, the fixed exchange rate. And to do that, they need to negotiate with a bank that in the future, we are going to make this transaction of this amount of currencies to exchange with this foreign currency at a certain agreed exchange rate. So that is what we call a forward transaction. So in the forward transaction, money does not actually change hands until some agreed future date. So a buyer and the seller agree on an exchange rate for any date in the future for a fixed sum of money, and the transaction occurs on that date. So the exercise date is usually in the future. So regardless of what the market rates are at that exercise date, the transaction has to occur. So for example, the exchange rate is more favorable at that time compared to that which they agreed. Therefore, it will become a loss to the company, but again to the bank, and the vice versa will be true. So the duration of trades can be a few days, a few months, or years, and the forward transaction can even go to commodities, etc., etc. And unlike other financial instruments, there is no public records of trades carried out, nor the amount of trades that are represented at any point in time.